It happened quickly, so quickly that most people barely had time to process what they were seeing. One morning in early 2026, investors opened their trading screens and were met with something that felt almost impossible. Shares of Intel were collapsing in real time. In a single trading session, the stock plunged nearly 17%. Tens of billions of dollars in market value evaporated before the closing bell even rang. For a company that once stood at the very center of Silicon Valley, the shock felt surreal. This was the same Intel that powered the personal computer revolution. The same company whose processors ran inside millions of machines across offices, homes, and data centers around the world. For decades, its dominance didn't just seem strong, it seemed permanent. But the market was sending a brutal message. This wasn't just a bad earnings report. It wasn't a temporary slowdown, and it certainly wasn't a simple missed forecast. What investors were reacting to was something deeper, something structural that had been quietly building for years. Because while the rest of the semiconductor world was evolving, Intel had made a massive bet on doing things its own way. And now that bet was beginning to break. To understand how a giant like Intel ended up here, you first have to understand how the semiconductor industry actually works. Most people imagine chip companies in a very simple way. A company designs a processor and then manufactures it in its own factory. One company, one pipeline, one production system. Clean, straightforward. But the modern chip industry doesn't really work like that anymore. Over the past 2 decades, the business quietly split into 2 very different models. The first model focuses purely on design. These companies create the architecture of the chips, build the software ecosystems around them, and push performance forward. But when the designs are finished, the manufacturing is handed off to specialized factories. This approach is known as the fabless model. Companies like Nvidia and AMD built their entire strategy around it. They invest enormous resources into research and chip design, but they avoid the staggering cost of building fabrication plants. Instead, they rely on the world's most advanced semiconductor manufacturer, TSMC. TSMC quietly became the backbone of the global technology industry. The processors inside smartphones, the GPUs powering gaming systems, and many of the chips driving the artificial intelligence boom are produced in its enormous fabrication plants. Intel, however, chose a very different path. For decades, the company insisted on doing everything itself. It designed the chips, it engineered the manufacturing process, and it built the enormous factories required to produce them. At first, this model looked unbeatable. Owning the factories meant Intel controlled every stage of production. It could push new technology faster than competitors and protect its designs from rivals. For years, that level of control helped Intel dominate the personal computer era. But building advanced semiconductor factories is one of the most expensive industrial projects on Earth. Each new generation requires machines worth billions of dollars, facilities the size of football stadiums, and years of development before a single chip rolls off the production line. And while Intel kept pouring money into that system, the rest of the industry was quietly moving in another direction. Companies like Nvidia and AMD focused almost entirely on innovation. They didn't have to worry about factory construction timelines or manufacturing delays. TSMC handled that side of the business, which meant those companies could move faster, they could design more aggressively. And when a new technological wave appeared, they were ready to ride it. Intel, on the other hand, was carrying the weight of an entire manufacturing empire. For a long time, that empire looked like power. But as the next chapter of computing began to unfold, it slowly started to look like a burden. By the early 2020s, the difference between these 2 models started showing up clearly in the numbers. Building semiconductor factories is not just expensive, it is brutally expensive. A single advanced fabrication plant can cost more than $20 billion to construct. Inside those facilities are machines capable of carving microscopic circuits onto silicon wafers, and some of those machines cost tens or even hundreds of millions of dollars each. And companies that want to remain competitive cannot simply build one factory. They must keep building them. New generations, new manufacturing processes, new equipment. For Intel, this meant one thing: constant spending. Year after year, billions flowed into massive fabrication projects across the United States and Europe. The company believed owning these factories would secure its future, control the manufacturing, control the industry. But while Intel was pouring enormous capital into infrastructure, its competitors were playing a completely different game. Companies like Nvidia focused almost entirely on design. They built the blueprints for powerful processors, while the manufacturing was handled by TSMC, which had become the most advanced chip producer on the planet. That difference completely changed the financial equation. Instead of spending billions on factories, Nvidia could invest heavily in research, software ecosystems, and next-generation chip architecture. It could move faster, experiment more aggressively, and pivot quickly when new opportunities appeared. Intel didn't have that flexibility. Every delay in its manufacturing process became expensive. Every new factory required enormous upfront investment long before any revenue appeared. The company wasn't just designing chips anymore. It was funding an entire industrial empire. And then, the technology world entered a new era: artificial intelligence. Suddenly, the demand for computing power exploded. Data centers needed massive processing capacity to train AI systems. Cloud providers were racing to secure the most advanced chips they could find. Companies built around the fabless model were ready to respond quickly. Intel, however, was still wrestling with the enormous complexity of running its own manufacturing network. The strategy that once made the company dominant was slowly becoming the weight holding it back. And when the AI boom accelerated, that difference became impossible to ignore. Then came the moment that changed everything. Around 2023, the technology world entered a new arms race. Artificial intelligence was no longer just a research project hidden inside universities and laboratories. Suddenly, every major company wanted it: cloud providers, startups, governments, and even traditional industries. Everyone was racing to build their own AI systems, and those systems require one thing above all else: compute power. Not ordinary processors, but specialized chips capable of handling massive parallel workloads. Training modern AI models requires enormous amounts of data flowing through thousands of processors simultaneously. This is where one company surged far ahead. Nvidia had spent years quietly building the perfect chips for this moment. Originally designed for graphics and gaming, their GPUs turned out to be incredibly effective at training artificial intelligence models. Demand exploded. Data centers around the world began ordering thousands of these chips at a time. Entire warehouses filled with AI hardware as companies rushed to build large language models and machine learning platforms. Nvidia quickly became the supplier of the AI era. Meanwhile, something strange was happening to the company that once dominated computing. Intel wasn't leading the AI boom. In fact, it was struggling to keep up. For decades, Intel's strength had been CPUs, powering personal computers, and enterprise servers. But AI workloads required a different architecture. The industry was shifting toward GPUs and specialized accelerators, areas where Intel had far less momentum. Even worse, its manufacturing system limited how quickly it could react. Companies using the fabless model could design new AI chips and send them directly to TSMC for production. Scaling up simply meant ordering more wafers from the world's most advanced fabrication plants. Intel had to rely on its own factories, and those factories were already under pressure. During its 2026 earnings call, the situation had become painfully clear. Executives admitted that production capacity for advanced AI chips was limited. Exactly when global demand was surging, Intel couldn't manufacture enough cutting-edge hardware to compete at scale. It was the worst possible moment to fall behind. The computing revolution that would define the next decade had arrived, and the company that once led the semiconductor industry was now watching the biggest opportunity in years slip through its fingers. For many people, the crash in 2026 looked sudden, but inside the semiconductor industry, the warning signs had appeared much earlier. The first major shock came in the summer of 2024. Investors woke up to one of the worst trading days in Intel's history. The stock plunged roughly 26% in a single session, and billions in value vanished almost overnight. The company's response revealed just how serious the situation had become. Massive cost-cutting measures were announced. Around 15,000 jobs were eliminated. The dividend that investors had relied on for years was scrapped in an attempt to conserve cash. These are the kinds of emergency measures companies take when they are trying to stabilize themselves during a crisis. But the deeper problem wasn't just spending, it was structure. Intel had spent years building a business around owning and operating enormous fabrication plants. Reversing that strategy would take far longer than a few quarters. Even a new CEO couldn't simply flip a switch and redesign the entire manufacturing system. Then another shock arrived. Longtime CEO Pat Gelsinger stepped down suddenly in late 2024. The leadership change added even more uncertainty at a moment when investors were already questioning the company's direction. For decades, Intel had been the unquestioned king of Silicon Valley hardware. Now it looked like a company struggling to keep its footing while the industry moved forward without it. Which brings us to the question investors are quietly asking today. Can Intel recover from this? Or does the company need to reinvent itself entirely? One idea keeps resurfacing inside the semiconductor world. Break the company in two. Separate the manufacturing business from the chip design division and allow each side to compete independently. It would be a radical move for a company whose identity was built around controlling both. But the industry has changed. Companies like Nvidia and AMD proved that focusing purely on design can create enormous value, especially when paired with manufacturing powerhouses like TSMC. Intel now faces the hardest challenge any technology giant can encounter. Not inventing the future, but catching up to it, because the story unfolding right now isn't just about one company struggling. It's about what happens when an entire industry changes faster than its biggest player can adapt. And the next few years will decide whether Intel writes one of the greatest comeback stories in the history of technology, or becomes a cautionary tale of how even kings can fall.